A 72-year-old widow thought she had finally solved her money problems. Her Social Security checks barely covered groceries, medicine, and utilities. Every month felt tighter than the last. Then one afternoon, she heard something on television that sounded almost magical. You can stay in your home, and the bank pays you. No monthly mortgage payments, tax-free cash, stay in your home for life. To her, it sounded like rescue. But 3 years later, her daughter sat at the kitchen table, staring at a letter from the bank, tears in her eyes. The debt had exploded. The house that was supposed to become a family inheritance was almost gone. And worst of all, she never fully understood what she had signed. Today we are talking about one of the most misunderstood financial products in America, reverse mortgages. Because depending on your situation, a reverse mortgage can either save your retirement or quietly destroy your family's financial future. And the scary part is this: most people do not realize the danger until the debt has already snowballed. In this video, we are going to break down exactly how reverse mortgages work, the 3 times they can genuinely help seniors, and the 5 situations where they become a financial disaster. We will also show you why the balance grows so fast, how interest quietly compounds against your home, why heirs sometimes lose most of the inheritance, and how Medicaid eligibility can become complicated later on. And trust me, the final trap catches thousands of families completely off guard. What exactly is a reverse mortgage? Let us start simple. A reverse mortgage is a loan for homeowners who are usually 62 years or older. Instead of you making payments to the bank every month, the bank gives payments to you. That money can come as a lump sum, monthly payments, a line of credit, or a combination of all 3. The most common type is called a home equity conversion mortgage, also known as HECM, which is backed by the federal government. Now here's the important part. You still own the house, but the loan balance keeps growing over time because interest and fees are added every single month. That means, unlike a normal mortgage, where the balance slowly shrinks, a reverse mortgage balance grows larger and larger over time. And many seniors never fully realize how fast that compounding can become dangerous. The compounding problem nobody explains properly. Imagine this. Bethany takes a reverse mortgage and receives $120,000 from the equity in her home. At first, it feels wonderful. She fixes her roof, pays off credit cards, helps her grandson with college, finally breathes again after years of stress. But the loan is charging interest, and that interest compounds, meaning interest gets added not only to the original loan, but also to previous interest. So the debt quietly snowballs in the background. A balance of $120,000 can become $160,000, then $210,000, then $300,000 or more depending on interest rates and how long the homeowner lives in the property. And here is the emotional part that many families discover too late. The longer the homeowner lives, the larger the debt grows. That means the family home slowly gets eaten away piece by piece. This is why financial experts constantly warn seniors to fully understand the long-term math before signing anything. Bankrate also warns that reverse mortgages can reduce inheritance, increase loan costs over time, and create risks if homeowners fail to keep up with taxes, insurance, or maintenance. But reverse mortgages are not always bad. This is where the conversation gets important because many videos online act like reverse mortgages are evil in every situation. That is not true. Sometimes they genuinely help people. In fact, for certain retirees, they can prevent financial collapse. So let us talk about the 3 situations where a reverse mortgage can actually make sense. Smart scenario number 1, the house rich, cash poor retiree. This is probably the best use case. Some seniors own homes worth $500,000 or even $800,000, but they only have $1,800 a month coming in from Social Security. Their wealth is trapped inside the house. Meanwhile, they are skipping medications, avoiding dental care, and choosing between groceries and utility bills. For someone in this situation, a reverse mortgage can unlock cash without forcing them to sell the home they love. And emotionally, that matters. because many seniors do not want to leave the neighborhood where they spent 30 or 40 years raising their families. For them, staying home brings dignity and stability. A reverse mortgage can sometimes provide that breathing room. Smart scenario number 2. Preventing retirement account disaster near is something many people never think about. Sometimes retirees panic during stock market crashes. Imagine your retirement investments suddenly drop 25%. If you start pulling large amounts from your retirement accounts during a crash, you can permanently damage your savings. Some financial planners use reverse mortgage credit lines strategically during bad markets, so retirees do not have to sell investments at terrible times. That can actually preserve long-term retirement wealth in certain situations. But notice what I said, certain situations. This strategy only works when handled very carefully with professional planning. Smart scenario number 3, a senior with no heirs. This one surprises many people. If someone has no children, no spouse, and no desire to leave behind a house, then protecting home inheritance may not matter much to them. For that person, using home equity to improve quality of life during retirement could actually be reasonable. Because at the end of the day, money is supposed to support life, not sit trapped in walls while someone struggles every month. That is where many commercials stop talking. But now we need to discuss the darker side, because the next 5 situations are where reverse mortgages become incredibly dangerous. Financial disaster. Number 1, your debt never stops growing. This is the trap that shocks families the most. With a traditional mortgage, every payment slowly reduces your debt. With a reverse mortgage, the opposite happens. The debt grows every single month. Interest gets, fees get added, and servicing costs get added. And because many seniors live longer today, the balance can become enormous over time. Imagine this. A homeowner borrows against their house at age 67. They live another 20 years. That loan has 20 years to compound. 20 years. By the end, the debt may have consumed most of the home equity entirely. And this becomes heartbreaking for families who believe the home would stay in the family for future generations. Many children discover too late that there is little equity left. Sometimes almost none. Financial disaster. Number 2, you can still lose the house. This is the part commercials barely mention. People hear no mortgage payments and assume the home is fully protected. That is not true. You still must pay property taxes, homeowners insurance, maintenance costs, HOA fees if applicable. And if you fall behind on those obligations, the lender can still force foreclosure. Yes, even with a reverse mortgage. This has happened to thousands of seniors across America. A retiree thinks they solved their financial stress, but rising property taxes or insurance costs eventually overwhelm them anyway. And remember, many seniors are living on fixed incomes while taxes and insurance keep rising year after year. That creates a dangerous squeeze. Financial disaster. Number 3, the inheritance shock. This is where Bethany's daughter entered the story. When Bethany passed away, her daughter believed the house would become part of the family inheritance. Instead, the reverse mortgage balance had grown so large that selling the home barely covered the debt. The family walked away with almost nothing. And emotionally, this part hurts deeply for many families. Because homes are not just buildings. They hold memories like birthday dinners, Christmas mornings, and grandchildren growing up in the backyard. Many parents dream of leaving that home behind. As security for their children, a reverse mortgage can slowly erase that possibility. Now, to be fair, heirs usually do have options. They can sell the home, refinance the balance, or pay off the reverse mortgage. But if the debt has grown too large, those choices become extremely difficult. And many families are simply not financially prepared for that situation. Financial disaster. Number 4, Medicaid problems later. This issue is incredibly misunderstood. Reverse mortgage proceeds themselves are generally not taxed because they are considered loan proceeds, but large, unused cash balances from a reverse mortgage can sometimes affect needs-based programs like Medicaid or supplemental security income if not handled properly. And this becomes critical later in life because long-term care is expensive very expensive. Many seniors eventually rely on Medicaid assistance for nursing home care, but eligibility rules can become complicated if assets and cash balances are structured incorrectly. This is why experts constantly warn seniors not to treat reverse mortgages like free money. Poor planning can lead to financial consequences years later when healthcare needs become serious. Unfortunately, many people sign these loans without ever speaking to an elder law attorney or a qualified retirement planner. That is a huge mistake. Financial disaster. Number 5, loneliness and fear lead to bad decisions. This final trap may be the saddest one. Many reverse mortgage decisions are not really about math. They are about fear. Fear of running out of money, fear of becoming a burden, fear of losing independence. And sometimes seniors make rushed financial choices during emotional periods of life. After a spouse dies, medical bills pile up, retirement savings shrink, and that emotional pressure can cloud judgment. A salesperson says, "You can stay in your home. You deserve peace. Use your equity." And in the moment, it sounds comforting, but major financial decisions made during emotional hardship can become painful later. That is why slowing down matters. Talking to family matters. Getting independent financial advice matters. Because once this process starts, reversing the damage later can be very difficult. So, is a reverse mortgage smart or dangerous? The honest answer is, it depends entirely on the situation. For some retirees, a reverse mortgage can provide dignity and financial breathing room. For others, it becomes a slow-moving financial disaster that quietly destroys home equity over time. That is why understanding the risks matters so much. The biggest mistake seniors make is thinking, this is free money. It is not. It is a debt secured by your home, and debt always has consequences eventually. Before signing anything, ask yourself these questions. Do I truly understand how the balance grows? Am I comfortable reducing inheritance for my family? Can I still afford taxes and insurance later? Have I spoken with an independent advisor? Am I making this decision from logic or fear? Because the right decision at 62 can look very different at 82. And that difference changes everything. If this video helped you understand reverse mortgages more clearly, share it with someone who may need to hear this before signing anything. Sometimes one conversation can save a family from years of regret.